And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday, technically speaking Tuesday, of course, and our new article is out this morning talking about 5 signs that, well, this market might just be a bit overbought here. So just a tad exuberant. It's been very interesting here over the last really month. As we were talking about back in August, we had been discussing taking some profits, reducing some exposure to the markets, because the markets had gotten very overbought at that point, and of course very extended, and it didn't seem like the markets were going to correct anytime soon. They just kind of kept grinding themselves higher. And then of course, as we were discussing back then, we'd said, hey, we've gone a very long time without a 5% correction. We've gone an exceedingly long time without a correction of the 200-day moving average. And we had 6 straight months in a row of positive returns. So why am I telling you all this? Well, because in the next month, of course, that was where we had that very elongated 5% drawdown. And this was where markets, CNBC was running markets in turmoil every day. It was up on the headlines and everybody's kind of freaking out. I'm getting lots of emails like, man, is the selling ever going to be over? And it certainly seemed terrible, but this was just a very normal kind of decline that occurred in the markets and a correction. Well, it's interesting here that after that correction, and of course all the angst that came along with it at that point, markets are now back at all-time highs. And it's very interesting now because investors are once again back to this, markets are never going down again. It's all good. I listen to headlines and I listen to media people and they're like, next year is going to even be better. And whatever happened this year is passé. Next year is going to be even better. Well, there's a lot of things that have to go into that, right, to make that occur. It doesn't mean that next year can't be another strong year for the markets. It certainly could. I'm not saying it can't. But you're going to need much stronger economic growth. You're going to need inflation to go down, of course. You're going to need earnings to continue to grow and profit margins continue to expand at the pace that they're doing. And these are all very small odds that can happen. There's a lot of headwinds that are facing another year of exponential earnings growth. And again, remember, when we look at earnings growth and we look at these type of things, this is all coming off very weak annual comparisons. Remember, we're comparing third quarter of this year to third quarter of last year. So that was where we were just coming out of the pandemic-driven shutdown. I'll get that spit out. And, we're just now getting people kind of really back to work fully, et cetera. So again, those year-over-year comparisons are going to become much tougher. And now with inflation running at over 5% in the near term, that's going to really put pressure on profit margins ultimately. That's going to put pressure on consumer spending. And that's going to also be problematic on a year-over-year basis because, again, inflation on a year-over-year basis, we were comparing against very low levels of inflation in 2021. Now we've got very high levels of inflation going into next year. So again, this is all going to make these comparisons. And that's really what all the market's about. It's about comparisons. Where were we against this other mark? That's what we kind of look at. And psychologically, that kind of feeds right into that as well, is that we had this big correction. And so now markets are going up. And as investors, we tend to forget that markets have these corrections on a regular basis. And we get all kind of caught up in the moment, right? It's like when we've got a hot streak at the poker table and we just kind of keep laying on the bets, right? So this is really kind of the thrust of the article that we've written today. It's on the website, realinvestmentadvice.com, talking about these 5 signs to pay attention to. And we'll go through those through the show today as well, because also yesterday's article was kind of the prelude to this one, talking about the vast, if you go back to 1900, right, and look at the data going back to 1900, we've got a very, very large extension in the markets that have never existed before. So, there's a lot of things that are occurring in the markets that are not normal. And a lot of this has to do, of course, with, the massive amount of liquidity that's been put into the market, of course, by the government. We had the $1,400 checks. We had $5 trillion of liquidity kind of pumped into the market through various programs last year. Then we had the Federal Reserve doing $120 billion a month. That's $1.2 trillion in liquidity every 10 months, right? And so that's been just another massive amount of liquidity that's been finding its way into the markets, either directly or psychologically. It doesn't matter. We've talked about that before. Whatever the case is, and however it is functioning, that Federal Reserve support is lifting asset prices. And in fact, the Federal Reserve came out yesterday. There's been a couple of talks this week. Richard Clarida was out yesterday. But the Fed making note that valuations are elevated. And going into next year, one of the risks to the markets, and this is from the Federal Reserve, saying, look, if we have a resurgence of the virus and have to shut down the economy again, or if something happens that creates a shock to the markets, or basically changing investors' attitudes about equities, the markets are very extended here, and you could have a very, very large correction very quickly. And again, the Fed's kind of noticing this. And this is a bit problematic for them because, again, if you take a look at that last FOMC meeting, which just happened last week, and we were talking about this, they opted to say, well, inflation is a problem. We recognize inflation being a problem, but we're not back to full employment yet, so we're going to be very slow about hiking interest rates. And the reason for that is that if you begin to hike interest rates, you're going to slow economic growth. That's what interest rates do. They're like a brake on economic activity. So if I increase interest rates, that means the economy will slow, and guess what happens to employment, right? Companies start to lay off employees and do those type of things to deal with a slower economic environment. So the Fed's really trapped between this inflationary pressure, which also weighs on the economy, and this idea of getting back to full employment. So, but by being cautious with that and by keeping the kind of the monetary policy and accommodative policies very easy, they're also opting to keep the market inflated here, even though they recognize that there's a valuation risk. So it's a very thin rope that the Fed is walking right now, and the smallest type of policy error, whatever it might be, underestimating inflation, overestimating employment, could all lead to basically a big unwinding of markets. Now, I'm not saying that's going to happen. I'm just saying that's a recognizable risk. Even by the Federal Reserve, they recognize it. The market tends not to talk about it much. The media doesn't talk about it for sure because the media just keeps telling you to buy stuff because it's going up. That is a true case. But right now markets are going up, but they're very extended. They're very overbought, and they're very optimistic. And this is kind of what we cover through today's article. And we kind of go through this idea, something that we'll talk about on the show today in a little bit more detail. But this is the time when you start thinking about risk management. I had a conversation with a friend of mine yesterday talking about this stretching of a rubber band in the markets, and that there's a point in time that that rubber band has to relax before you can stretch it again. And that was very much the case back in August. And then we relaxed the rubber band essentially through that correction in September and October. Now we're back to very, very stretched, even more so than we were back in August. So what causes the correction? What's going to happen that's going to make this massive run, for the exits by investors? Who knows? Could be something as simple as we've talked about before. Mutual fund rebalancing is coming up, and that happens over the next month. It's going to start slowly right around Thanksgiving, picks up steam going into the first 2 weeks of December. Typically, you tend to get a correction, 1, 2, 3%. And again, we're not talking about a major crash. And this is kind of one of the misnomers that people make. They think when we talk about a correction, we're talking about the market crashing. We need to be all in cash. No, just a small pullback here. Relax that rubber band so you can A, buy things cheaper, and B, enjoy the ride on the next trip up. We'll get into more of this after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We're putting 2021 behind us. and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and market, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. Realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Difficulties here in the studio this morning, so bear with us 1 second. Technology's great until it decides not to function properly. So, a couple of things for the break. Just talking a little bit about market exuberance, and this really kind of ties into what's happening with the market in general. If you take a look at valuations as an example, and again, valuations are often maligned because when you say, well, valuations are now the second highest level in history. We're at 40 times trailing earnings. We peaked at 44 times earnings in December of 1999, just as a comparison, right? So the bulls say, well, we're not as overbought as we were, overvalued as we were in 1999. Yeah, you're only 4 percentage points away. So, it's not, you're not that far away from being as overvalued as we were back in 1999. Of course, there's lots of ways to basically kind of discount valuations. And the reason that valuations often get, kind of maligned by the media is like, well, we've been overvalued here for a while and markets haven't corrected yet. And this is often a misnomer about valuations in general, which is that valuations, predict crashes. And that's not true. What valuations tell you, and this is the only thing that valuations tell you, is really what your forward returns are going to be over the next period of time, over the next 10 years, next 5 years, next 20 years, next 30 years. The higher the valuation, the lower your return will be in the future. And that's just a function of the way the math works over time. But it also just makes perfectly logical sense. If I go into my neighborhood today, as an example, and every house in the neighborhood sells for $500,000, and I pay $1 million for a house because we're in the middle of a, kind of a housing bubble rocket ship at the moment. it's fine. And I may be able to resell that house in 6 months for $1 million, maybe even $1.1 million, right? Because psychology and markets are moving the markets very quickly. So sure, I overpaid for a house in a neighborhood where every other house is $500,000. I pay $1 million for this. And by the way, the house is no different than any other house. Every house on the block is exactly the same, right? So I pay $1 million for this house. And sure, over the next 6 months, 9 months, a year, I may be able to resell that house for $1.1 million because of the insanity kind of going on in the markets. So overpaying for a house in the short term may or may not be a bad thing, depending on your holding period. The problem is, though, if I hold that house long enough, the cycle is going to change. And at some point, when people come into the neighborhood, they're going to say, well, there's, 12 houses in this neighborhood. They're all $500,000. And, I'll buy your house from you for $500,000. And it's like, well, I paid $1 million for it. Okay, but it's worth $500,000. It was always it was always a $500,000 house. You just overpaid for it. And so what investing in anything, whether it's a house or, a piece of land or a, stock investment or a mutual fund, whatever it is, if you overpay for it, the natural declination over time is going to reduce that valuation. And so your return is going to be lower in the future because you overpaid for it to begin with. And this is particularly true when it comes to equity investments, when we discount things like valuations, like earnings, those type of things, and we come up with new rationales for overpaying for something. And that's really what's going on in the markets, is that we're simply trying to come up with rationales for overpaying for value today, expecting that somehow magically things are going to do, things that have never occurred before in history. We're gonna continue to elevate prices at a level we've never done before in history. So, this is the type of mental gymnastics that investors go through to try to justify overpaying for value of assets today. The problem, as we said, is that over the course of the next decade or two, those valuations will reverse. And it is not a question of if, maybe, possibly, sort of, kind of. They will. Valuations will revert to their mean, and they have always done it. They always will do it, and it's simply just a function of market and economic cycles. So this is the value of valuations. Terrible market timing devices, though. Trying to manage your portfolio based on valuations will lead to horrible results over time. So don't do it. Just understand what valuations are telling you. And when you're trading at 40 times earnings, what does that mean, right? We throw these numbers around, but we don't throw them around with any type of context. And so we really don't understand. All we know is that, market's overvalued. I really have no idea what it means. Well, what it means is simply this. At 40 times earnings, if I invest into a company, I give a company money, right? And I invest in their stock. At 40 times earnings, all that means is if the company pays me back every year my pro rata share of the earnings of the company, in 40 years, I will get my money back. Now, that doesn't mean I get my money back plus interest. I get my money back. And it'll just take me 40 years to do that. So basically, you've given the company a 40-year interest-free loan on your money at 40 times earnings. So once you start thinking about it in these terms, right, what's your time horizon to retirement right now? Well, I've got 10 years to retirement. I've got 15 years to retirement, whatever it is. Okay. And you just invested in stocks with a 40-year duration. That's the problem. See, this is where this comes down to being problematic for investors and buying into overvalued assets at the peak of markets. Now, let me be really clear. This does not mean that you go sell everything, go to cash today. Well, Lance said the market's overvalued. I better go to cash. No, that's not what I'm saying. As I said, valuations are a terrible market timing device. What they are great at, and the only value they serve, is telling you that your forward return expectations are likely near zero over the next decade. What does that mean? How can that be? Am I just going to make no money over the next 10 years? On the total holding period, yes, your total return on your investment over the next 10 years on a buy and hold basis is going to be near zero, including dividends. Does that mean every year is going to be a zero return? No, that's not what that means at all. What it does mean is that at some point you're going to have a reversion in the markets, or 2, or 3. Don't know how many there'll be over the course of time. We can go back and look at the 60s and 70s. We can go back and look at 2000 through 2013. But you have 1 or 2 or maybe 3 fairly sizable corrections that you then spend a few years getting back to even on before the next correction occurs. And when you look back at the course of your last 10-year holding period, you go, wow, I didn't make any money. There'll be some great opportunities in there to make money, right? There'll be some good opportunities on the long side and some good opportunities on the short side. Question is just navigating that, managing that risk. This is why buy and hold investing is the best source of portfolio management during a rising bull market. It's terrible during a declining bear market, and both happen. Problem is, as investors, we've got to know which market we're in and which market is potentially coming and how to prepare for that. But that's why when, here on the show in particular, the one thing that we discuss the most and the one thing that we continue to kind of harp on the most is about the management of risk. And this doesn't mean that you buy and sell everything and move entirely in, entirely out of the market. You can't time the markets that effectively. But you can increase and reduce risk. You think about this kind of like driving a car. And, I'm driving a car, I'm heading down the road, and I just don't keep my foot slammed onto the gas pedal all the time, right? Right? There, there's a car in front of me, he's got brake lights on, there's a turn coming up, there's a, stop sign coming up, whatever it is. When I'm driving a car, I'm constantly making adjustments, right? I'm constantly moving the car left and right to stay in the center of my lane. I'm constantly adding gas or braking the car to speed up or slow down accordingly as I need to. I'm constantly making these minute, unconscious adjustments. When you're driving, you're making all kinds of adjustments when you're driving your car. It's all subconscious, but you're doing it to control the car. But yet, when we go to investing, we just buy stuff and we just hope it goes up. And just like in driving a car, there's risk. The reason we make these minute adjustments while we're driving is to avoid having a crash, right? That's the risk. The risk of driving is a crash. So we make these minute adjustments to try to avoid that risk outcome, which is the crash. If we just lined our cars with bubble wrap, we could just play bumper cars down the freeway and it'd be all fine, right? But that's not the way it works. And it's not the way that it works in investing either. Investing is the car, and we've got to constantly make small, minute adjustments in order to avoid the eventual crash, because eventually it will. Eventually you will lose money, and you'll lose a lot of money. That's the part we want to try to avoid. And that's when we talk about managing risk here on the show and talk about the things that occur. And this is why valuations are a very important warning sign. It's like that big flashing yellow sign, as you're driving down the freeway, caution, workers ahead, caution, bridge out. That's what valuations tell you. We can choose to ignore it, try to play Smokey and the Bandit over the bridge, but, odds are it doesn't work out well. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and markets, we'll share insight from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN. RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You know that we've gotten to the peak mania point when you see everybody rushing out now to do a SPAC, special purpose acquisition vehicles. A-Rod has come out with his own SPAC. Colin Kaepernick has one. Shaquille O'Neal has one. A new one out this morning. Climate change crisis is real. You want to raise money for a cause?
Listen to the Real Investment Show podcast from your favorite service.
Start a SPAC.
Same show, your schedule at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. I'm Lance Roberts. So on our website this morning, we've got two articles out, one yesterday and one today, talking about, and they kind of go in sequence together. The first article from yesterday is talking simply about the deviation from exponential growth trends. And look, I know that's a bunch of technical mumbo jumbo, and for you math geeks, you get it, but for everybody else, they're like, oh my gosh. Look, all it tells you is, again, when we're looking back at history and you're looking at things that are abnormal to how markets work, these are just those kind of warning signs that you should at least be paying attention to kind of what's going on. And look, right now, we're having this conversation almost daily in our office. We've got stocks in our portfolios that are doing things that they shouldn't do. We've got NVIDIA as an example, and Ford and AMD in our equity models that are trading at 4 and 5 standard deviations above their long-term means. They shouldn't do that, but they are, and that's just the way that the market's working right now. And it looks like it's going to continue to do that today. The market on Friday was up 18 days with only 2 down days. So out of the last 20 days, 18 days were up, 2 were down. How many times in history has that occurred? Exactly 0. Monday was 19. Today will be 20 if we finish the day on the positive. How many times has that occurred in history? Exactly 0. So the markets are certainly doing things currently that they shouldn't do, and there's a lot of speculative risk-taking that's going on in the markets, and there's plenty of evidence of that, right? I mean, you take a look at the number of people long calls and long puts, and it's a massive deviation between the two. In other words, nobody's buying puts. Nobody's worried about downside protection, but they're buying all the upside, give me the juice participation that they can get, right? People are very speculative and taking on a lot of speculative risk. And look, I get it, right? I mean, right now earnings are doing great. Margins are good. Everything seems to be firing on all cylinders. Really not a whole lot to worry about here. COVID is declining sharply, even the Delta variant. Those cases are declining sharply. The world is getting back to normal, so to speak. So these are all things that, are certainly boding well for the markets in the economy short term. And the downside to this, of course, is we're getting a big inflationary surge. And I thought this was interesting. Yesterday, MSNBC had a whole segment on discussing how inflation's actually a good thing, right? And now you got to go back, and kind of, in history, last year they were talking about there won't be any inflation. And then they were talking about there is no inflation. And then they're talking about now inflation is transitory. And now they spin that to say inflation's good. How is inflation good? Well, inflation's good, if the economy's doing better and wages are doing great and, all kind of, things are working as they should, right? See, what we forget about inflation is there's good inflation and there's bad inflation. So let me explain good and bad inflation, then you can decide as to whether the inflation we have currently is good. Good inflation occurs when you have very strong economic growth that's leading to higher productivity and higher wages, and where the growth of those wages and incomes are outstripping the rising cost of living. So, in other words, people are making more money. The economy is growing very strongly, so people are getting paid more. And you've got real, true, full employment. And you've got full employment where you have labor force participation rates in the high 70 percentiles, not in the low 60s. Okay. There's a lot of kind of minute factors that go into this, but what you're looking for is economic growth that is growing, and as economic growth is growing and people are producing more, right? So you get more people to work, and you out of your 300 million in your population, you've got 70-80% of them working, all producing, which means they're all getting paid first. And then they take that money home and they're going out to buy stuff. So as that demand push is coming from organic economic growth, producers are having to produce more because they've got a lot of demand, and that is a sustainable level of demand because you've got rising economic growth. Of course, as I'm producing more, I've got demand outstripping supply. Then what I've got is I'm able as a producer to charge more for my services. That's good inflation. Don't mess with that inflation. Doesn't matter if inflation is 4. If economic growth is 8 and you've got 5% inflation, don't mess with it. It's fine. Problem is today, or I should say, I don't want to, caveat your opinion here, but taking a look at today's environment, we've got economic growth that just turned in 2%. You've got inflation at 5%. You've got wages that are rising on the low end of the wage scale because of a lack of supply of workers. And you got a 62% labor force participation rate out of a population of 300 million. And when you take a look at the number of people that are out of the labor force as a total, and what we call no longer in labor force, that number is surging. We all want to write this off as to people just, deciding to retire. But given that 80 to 90% of people have less than 1 year's worth of salary saved up in the bank, it's hard to suggest these people are all just kicking off on the bucket and sitting on their front porch with their dog named Bo looking at the sunset. So in this environment, where inflation is outstripping wages and economic growth, is inflation a good thing? And I think if you ask most people right now, when they go to fill up their car at the gas station, or whether they go to the store to buy groceries, or whether they want to go take a trip, whatever it is, right? The costs are going up markedly, and it's going up faster than their incomes can support it, and they're not able to buy as much as they would like. And so where do they go to fill in the gap? And that's turning back to credit card debt, which is surging, by the way, right now, because of exactly that reason. So is that good inflation? Is that the inflation that we want to have in the economy? So assuming that you say, no, that's not the type of good inflation we want, that's actually a type of inflation that deteriorates economic growth because it slows consumption eventually, then that sets up a very different type of market environment next year. Because the one thing that's been driving market returns over the course of the last couple of months is what we call margin expansion. Margin expansion means that the profit margin that companies have has been growing. And why has that profit margin been growing? Well, we shut down the economy last year entirely back in March, April, May. Started slowly opening back up. And of course, what companies did is they just laid off mass numbers of people. They reduced their overhead dramatically by moving to more productive forms of operations, having people work at home. And this vastly increased the profit margin of the business. Now we're talking about having people come back to work, reducing that efficiency, hiring more people, paying higher wages. So in the future, and we have these supply chain disruptions that are driving up prices. So in the next year, what is likely to happen with profit margins? Are profit margins going to continue to maintain their current level or expand? Or are profit margins going to decline as the cost of higher costs, whether it's employee cost, benefit cost, price cost, etc., comes into the companies, and the companies have a choice. Either I can absorb that cost or I can pass it on to consumers. Now, assuming I can pass it on to consumers and consumers will pay a higher price, then I have some pricing power with consumers, then maybe I can maintain my current margin levels. Probably not going to be able to expand it much, but I'll probably can maintain it. However, what happens if I go to pass on that profit margin, pass on that inflation to consumers? What happens to my profit margin if they refuse to pay it? Or what I mean by that is they start buying less of my product, good, or service. Then my profits are going to decline. So at some point, a company may have to make the choice of absorbing that inflationary cost. And of course, if they absorb that inflationary cost, in other words, they take the higher cost of product, they don't raise the price of their goods or services in order to remain competitive in the markets. If they don't raise their prices to offset the incoming inflation, then that erodes profit margins. So the big risk to companies over the course of the next really year, and when we talk about earnings growth expectations that are very elevated, we talked about this on the show, I think, last week, that expectations are above the long-term trend for the first time ever in history, right? The expectations are that we're about to grow earnings faster than has ever occurred in history. Question is who is likely to get disappointed? The markets or consumers? And that's one of the things that we overlook here in the markets. And this is the one thing the MSNBC is overlooking, is that, trying to make this narrative that inflation is good. Of course, they're also trying to support the current administration. The problem with higher inflation is when consumers can't absorb it. And there's already evidence that we may have already reached that point. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
We're putting 2021 behind us and getting ready for 2022. Be prepared with Lance Roberts' year-end economic outlook in our next Candid Coffee, Saturday, November 13th. From taxes to interest rates and market, we'll share insights from Richard Rosso, Danny Ratliff, and special guest barista Lance Roberts. Saturday, November 13th. Register now at realinvestmentadvice.com. Candid Coffee with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Futures for the Dow are down just a little bit. S&P futures are down just a smidge this morning. So again, we've had 19 up days and only 2 down days over the last 21 days. That is the longest stretch on record. Never occurred before. So, what happens next? Who knows? But, markets are going to be a little bit flattish this morning. We'll see if the markets can recover, kind of get their go-go juice here going in the next, little bit after the market opens. This morning, General Electric is going to be up about 20%-ish at the open. We'll see how this thing opens. But General Electric, which through several times in market history was one of the largest cap companies in the world by market cap, it's been at the top a few times, dropped off, and the last time it was there was back in the early 2000s. Since the dot-com crash, General Electric has been slowly kind of reorganizing themselves over time. And after the financial crisis, they did some more, spinning off, assets that were not performing well, et cetera. And of course, General Electric is this kind of giant behemoth conglomerate that was, in aviation and healthcare. Then they spun out and got into financial services with GE Capital. And, pretty much wherever they saw opportunity, they were establishing a kind of a beachhead. And some of it worked out well, a lot of it didn't. And GE has been, having a lot of struggles ever since. And in their latest innovation, and this is, of course, about 3.5, 4 years now, since they were removed from the Dow Jones Index. And GE was in the Dow Jones Index for like 100 years, just as a reminder. They were moved about 3.5, 4 years ago from the Dow. GE announced today that they're going to split into 3 companies. And this is after years of activist shareholders that have been pushing really for structural changes to try to unlock some of the value, because they do have some very valuable assets. Their energy business, their aviation business, their healthcare business does very well. And the problem with it being all locked up into one company is that the bad units were dragging down the good units. And so now the goal here is to split the company up into 3 parts. So I'm going to read this for you just to make sure I get it all right. The split will create 3 separate companies focused on aviation, healthcare, and energy. The healthcare unit should be separated by early 2023, so it's not going to happen quick. And the separation of the company combining GE's renewable energy and GE power units is expected to be finished by 2024. What remains will be the GE aviation unit. So once they get their healthcare, their energy, and their aviation spun out, there'll be 3 different companies. So if you want to just be in the GE healthcare unit, you can do that. Spinoffs are hardly a new thing. Of course, like I said, they've been really kind of shrinking the size of the company ever since the financial crisis. The GE name will live on with the aviation unit, which will continue to be led by GE CEO Larry Culp. Originally, GE was founded in the late 1800s by Thomas Edison. Of course. So we'll see kind of what happens here, but the stock is responding very positively this morning because, again, if you own GE, at some point in the future, you're going to get all 3 companies when it gets split up. But again, this is good news for GE. They've been struggling for a long time. We'll see if this truly works to kind of unlock some value. But if you've been long GE here, kind of as a shareholder, you're finally going to get a little bit rewarded today. The stock has been performing okay this year, but this is going to get a nice pop this morning. So we'll see what happens. But kind of an interesting story. I think we're going to see more of this activity. Again, there's a lot of this activist investing going on right now for companies, and particularly in the energy space. We're seeing a lot of this. ExxonMobil, of course, recently picked up new board seats from a company called Engine One, which is really focused on trying to convert ExxonMobil to more green energy production, less efficient, more costly. But hey, we got to do more of that, right? Royal Dutch Shell is being kind of pushed at this moment by Dan Loeb over at Third Point Capital for the same thing. Excuse me. Trying to break up Royal Dutch Shell into 2 units, one being for legacy oil and gas assets that would be just paid out over time and eventually eliminated, and then new capital and new infusions of cash into the renewable energy side of the business, which is less efficient, less profitable, but that's where we want to start putting money. And if you can figure that out, well, there you go. But that's kind of the goal by a lot of these activist investors trying to jump on this whole bandwagon for, clean energy. So we'll see what happens. Again, we saw, and we talked about this before, we saw this back in the late 90s. And here's a quick take for you, by the way. In the late 90s, we were talking about how sin stocks were terrible and that, investing in cigarette stocks was, a dead cat and you shouldn't own them anymore. And it's terrible. Here's a question. Since 1970s, if you invested in Philip Morris or in Apple, which one made you more money? A $10,000 investment in Philip Morris has now made you $27 million. It has been an absolute killer, and that's with dividends reinvested because, this is, one of the problems when it comes to investing is we get off onto these themes of, we want to be conscious investors and we want to do this and that. Your investment does nothing. When you buy a stock, it doesn't even move the needle for a company because you're buying so few shares. They don't even know you exist. Right. And, the problem ultimately is that you've got to buy enough shares of a company to go get a board seat. So, figure out how much you've got to own of GE as an example, or of Philip Morris or of Apple to garner a board seat. And if you can do that, well, you can actually start influencing decisions. This is the whole premise behind Warren Buffett, right? You want to invest like Warren Buffett, you've got to buy enough of a company where you're on the board of directors. And you can force the direction of the company. You buying a few shares of Apple or Tesla or whatever, you're not doing anything except giving somebody else money. There was a guy selling his shares of Apple, and you bought them, and y'all exchanged money for shares. That's it. That's all that occurred. You're not influencing the decision of that company at all. So from that standpoint, understand what your job as an investor is, which is to make your money grow. That is your job. So forget all the fad investing. Forget all of the theme investing. It doesn't matter. Invest in where capital is growing. And right now, look, a lot of those themes are working, right? Because you got a lot of money chasing that theme. And so, yeah, take advantage of it. Just understand that those themes and fads, they fade. And what ultimately matters down the road is valuation. As we started out the show by saying, what you pay for a company dictates what your return will be over time. And right now in the marketplace, we have, out of the S&P 500, more than 75 companies trading at 10 times price to sales. That is an astronomical valuation for companies. And having 75 out of 500 trade at 10 times price to sales or more is a record by far of any other point in history. All it's telling you is that investors are paying way too much for money and for assets. And eventually, that doesn't play out well because the company, the earnings of the company, and the revenue of the company cannot grow fast enough to support those prices. So again, regardless of what you think, your job is very simple as investors, to make your money grow. That's it. Forget all the other stuff and invest accordingly. Manage your risk so that your money grows safely over time. That's your whole job. That's why I'm writing an article right now called "Buying is Easy, Selling is the Hard Part." Because, it's easy to buy stuff, particularly in this type of a market where things are just going up every day. It's like, I just buy something and it goes up. And that's the great thing about a bull market. Bull markets cover up a whole variety of investing sins. And the bull market forgives you for making these sins. But ultimately, when that market changes, the bear market side of the transaction is not so forgiving, right? It's kind of like instead of a bull and a bear, we should have a devil and an angel, right? During an angel market, the angel just forgives you all the way, right? Oh, it's okay. I forgive you for making that investment. It's okay. Devil's not so forgiving. And he'll punish you every single time. And during a bear market is when that occurs the most. All those investing mistakes that you made, all those, overestimations, all those, overpayments for valuations, all those things that you did that the angel was forgiving you for, the devil will punish you for multiple times over and will punish you more than you ever thought possible. And we've seen it before. If you've ever lived through a bear market, you know exactly what I'm talking about. You know exactly what I'm saying. And the problem for a lot of, people on television today and the media, as well as, a lot of, writers and people on TikTok and Twitter and all these other places that are, spouting, investment advice and having trading classes and all this. They've never been through a bear market. If you go take a look, when did they start investing? Some of them just a couple of years ago. Some of them maybe 2011, 2012. They've never seen a bear market. They don't know what it means, and they don't know what happens during a bear market. But these are lessons that we only learn through experience. And once you've been through 1 or 2 or 3 bear markets, you learn these lessons. These are just simple investing axioms. It doesn't, it's not rocket science, and it's not anything mystical, and it's certainly not bearish. It's just simply an understanding, as I said earlier in the show, it's like driving a car. You understand the rules of the road, and you follow those rules. And if you do that, you get to your destination safely, and that is the whole point of investing. I'm Real Lance Roberts, wrapping up the show for today. Be back tomorrow, of course, with Danny Ratliff right here. Be sure to go to our website. Our new articles are out. We have one on the Technically Speaking post of the day, which is talking about the 5 signs the markets are way too bullish, and talking about long-term trends of market. That was Monday post. It's all there for you on the website, realinvestmentadvice.com. While you're there, also get registered for this weekend's Candid Coffee. Love to see you there. We'll be talking about markets, money, and more. See you next time.
It's a rich man's world.